Well, today I have the pleasure of speaking with David Jensen again. We even have a David Jensen playlist if you want to look at our previous interviews. David Jensen is an analyst in the precious metal space. You can find him on Substack, Jensen David. On Substack, it's Jensen's Economic Precious Metals and Markets new newsletter. And I wanted to have David on to talk to him about the war in Iran and also silver. David, welcome back to the channel. Always great to speak with you.
Yes, great to be with you again, Mario. I look forward to the discussion.
Yeah, and we're going to start, David, with what's going on in the Middle East. You've got an interesting article you wrote about how this conflict could trigger basically the end of the global credit-fueled asset bubble that we've had, I would say, since the early 80s when bond yields topped in the US at 15.5%, I think, was a 10-year. So, yeah, I'll let you give us your opinion on what's going on.
Yeah, I see it all as being intimately related. We've all been tracking, you and I and others have been tracking this destabilization of the promissory note pricing systems in the global precious metals markets. And the reason that's important is that the silver and gold have historically been the primary warning systems of inflationary monetary policy. And my working thesis is that interest rates have only been possible because of the invention of the promissory note market in London starting in 1987, where infinite amounts of silver and gold were then made available to market through selling promissory notes for immediate ownership and delivery of gold and silver. And what we've seen now is this relentless drawdown, really highlighted in the silver market, but it appears that the silver market is heading into a global crisis because of the shortage of availability and the extreme leverage that exists in all of the world's major markets, Shanghai, New York, and London. London being, until now, the primary physical gold market globally. And what it portends is the failure of the leverage system for price setting gold and silver at very low levels and taking away their monitoring and warning capacity. Is that if you lose control of that, then this era of infinite credit, we've seen interest rates decline from 19% in the early 80s to 0% for a decade until recently. And with gold and silver now for the last several years running higher as this global shortage has appeared in the markets, it indicates to me that there is a relationship there, that interest rates have run and gold and silver have run now, and that we're ending this era of cheap credit and leverage in the financial markets and in the economy itself. So the war, I believe, is also related to that. Trump has been pushed into this. I don't think it was his choice. I think he's been pushed into this. And, whoever his handlers are, I think that both he and Netanyahu have handlers. And, there are personal reasons. I think that both of them find a war helpful at this time. But I think that the system now is at a hinge point. And we have, a great reset in interest rates going much higher. But then a unwind of these leveraged financial markets globally, which now stand at a valuation of $270 trillion. And, we need an explanation as to why that happened, and we could blame it on war and oil and other things.
So, mentioned that before we started that you think this war could be like the trigger for for this credit-fueled asset bubble to unwind, and because commodities are becoming more and more unaffordable, and like you said, up until recently, it was really easy to get things. Credit was
Right.
really cheap.
Right.
So do you see oil also remaining elevated, and also is that part of this whole thing? And then and then we can look at silver. So do you think oil will because oil is really important for not just for energy but for other things like fertilizers. Sorry, you mentioned
Yeah.
that. So if you could go over that.
Yeah. I think that real assets have been drastically undervalued in this multi-decade, 40-year window, where financial instruments were viewed as wealth, especially debt instruments, bonds. We've got the famous 60/40 recommended by these wizened financial planners that you should have in your investment account, and there's a lot of debt in those. But what has really happened, from what I can see, is that we all know, or those I think with insight into the real economy, is that inflation, and this is a Austrian school view, is that inflation is always starts with an increase in the money stock, in the currency in the system. Really, it's not a money stock; it's a currency stock. But so what we've had now is that while the gold and silver market price action and warning system was suspended by these promissory note markets, is that we've had the currency in circulation. If you look at M2, for instance, in the U.S., it's gone up. It's 800% of what it was in 1987. And so inflation, when we use the classic definition of economists, which was an increase in the money stock or the currency stock, has gone up, and everybody said, well, there's no inflation, and we know that there's issues in terms of restating inflation calculations with hedonics and rebalancing the indices, et cetera, et cetera. But the key has been that while the markets were asleep because gold and silver weren't responding, and Greenspan himself said that his primary inflation warning signal of when they were running too loose money policy was the price of gold. And I would add parenthetically silver, because silver is gold on steroids oftentimes. But the monetary inflation that they embarked upon was sequestered for a period, because you can't do it forever, but was sequestered in financial instruments. And so we've had this gross inflation of the financial markets now to the point where they're $270 trillion. And now, over the last 3-4 years, we've had gold and silver running hard in terms of price because of the inevitable shortage that happens when you engage upon price fixing down a price of a commodity. And they've been running hard now, and we have a shortage of these metals globally. And I think we're kind of to the point where it's just going to be impossible to fix down these instruments, gold and silver, further with these promissory notes. And we've seen, interest rates run from 0 up to the 3 to 5% range. And what is interesting is two things, Mario, is that as we're entering into this extreme distress in the global silver market, that all of a sudden we have Trump go from being an anti-war candidate to a rabidly pro-war candidate, against an opponent, which is going to cause chaos globally. And the second thing that we have is that we have this distress physically showing up in the silver market, in particular in terms of the rapid drawdown in these silver stocks. And I think it's going to be the market that snaps first. And what we've had now since the war started is interest rates have gone up since the March 1st, February 28th initiation of the war. So you can see, if you look at the German or the UK or the US bonds and treasuries, that they've all gone up in yield while this war has exploded. So, the safe haven status of bonds seems to have been muted or flipped, inverted, whereby with this war that people have been selling these air quotes safe havens. And I think it's greatly related to the fact that people can see that if you have rocketing prices of fuel and 50% of the world's seaborne fertilizer comes out of the Persian Gulf there, that you're going to have a tremendous appearance of price inflation after a 40-year sequestration of the monetary inflation into financial instruments. And so I would say, to getting back to your original question, is yes, gold, silver, oil, foodstuffs, and materials in general, I think are going to see tremendous price inflation going forward here as the consequences of this war vest. And there's going to be basically a drastic move out of this $270 trillion dollar repository of digital financial instruments into the things that you can't print. Everybody knows that when you run wars, you have tremendous deficits, and you have a devaluation of the currency that comes. And the problem that we have is that these real assets are 0.75% roughly of the global financial instruments. Just looking at silver and gold, their annual supply to market is about $0.8 trillion. And we've got $270 trillion of these financial instruments. We're going to have a vacating, I think, of that space at the margins. When you've got that large a number, is that you can basically reset the price of real assets far, far higher in a very short period. And then you have I call it a horrific reset as the appearance of what the central bankers have been doing for decades comes to the fore through these the prices of these real assets.
Yes, it almost feels like all the chaos and wars that we've seen in the last few years are kind of like a symptom. It's almost subconsciously like people and leaders and business people know that this is going to happen, and they're rushing for things that have real value because they know the paper is toast. Is that the way
Exactly.
you feel?
Yes. Yeah, especially for the Israelis. They have some work that they want the American military to do. And if you can see the fact that you're going to be heading into a period of currency crisis, it's very difficult when you have that kind of chaos unleashed in your country to explain to your people that you need to go into the Persian Gulf and do some work for Israel. All right, it's very, very difficult to explain. So, and I would argue that the bankers ultimately, who are the hand that seem to be running things behind the scenes, they need another explanation for why gold and silver have become unhinged and the bond market has gone sideways, and these wonderful financial instruments they promote have gone sideways.
Yeah, they'll blame everything on the price of oil. Like they kind of did that in the 70s too.
They did. They did. Oil shocks.
And we know that it wasn't that. It was it was a result of taking the U.S. off the Bretton Woods system.
Right.
I would say.
It was the 1960s currency inflation shock, which was vesting in the 1970s. but
That's
it was blamed on Arabs and Arab oil, et cetera, et cetera.
the same playbook, I guess, they're using. I mean, it's not going to fool me or you. Hopefully, it won't fool that many people, and that's why we make these videos. And David, could we go over what's going on in silver? Because I have a feeling you feel like me that silver is like a canary in the coal mine, but
Yeah, it's a harbinger, right?
as a harbinger, but also on steroids. It's even more than gold, right?
Yeah,
Because
yeah,
back
because
in 1980, when the system was under threat, silver did the same thing. They blame it on the Hunt brothers, but
yeah.
it wasn't just that, I would say. So should I bring up these numbers here? So
Yeah, let's look at that spreadsheet. So this morning I put together this spreadsheet looking at the major exchanges. So London is being the foremost physical global exchange until now, and the U.S. The Chicago Mercantile Exchange COMEX market with the New York Vault data, and then the Shanghai Futures and Shanghai Gold Exchange data. And what we can see there, so looking at the first one there, the London market, so I compared February 1 this year to March 10 this year. And, the London market only releases data to the market once a month in terms of total vault holdings. But there's two things you have to deduct out of those holdings. They say there's, over 700 million ounces of silver in their vaults. But when you pull out the vault silver that's owned by the exchange traded funds or the ETFs, that's not supposed to be available to market because they're supposed to be holding it for their shareholders. So we have to assume that they're doing that. So we take those numbers out. And then if we pull out 140 million ounces that was in the London market, X the ETF holdings back in October, when the London market had a seizure where it stopped trading for an hour and a half in the day, with no offers of metal liquidity to market. Literally, analysts were saying there's zero liquidity in this market, and they had never seen it before. And that's a market that trades over 780 million ounces a day in the cash market, immediate ownership market, and all of a sudden there were zero offers. So we pull out those 140 million ounces that were available at the time in the vault's XETF holdings, and we see that there was roughly 80 million ounces on February 1, and now there's 57 million ounces available to settle these cash contracts, which number over 2 billion ounces by my estimates, given the volume of trading that we're seeing there. So it shows a drawdown there of about 22.9 or 23 million ounces in that 5 and a bit week period. A 29% drawdown, and then we can just run down and we can see, the COMEX, the registered silver accounts is what I show there, and I only look at the registered silver accounts because they are what is available to market, and these numbers reflect both deposits and withdrawals generating these levels. So, in the 5 weeks since February 1, we've seen a combination of deposits and withdrawals result in about 79.98 million ounces left in the COMEX registered accounts. And that's a 24% drawdown. And then as we quickly go down here, the Shanghai Futures, which looks like it's in serious trouble, it's had a 5.5 million ounce drawdown, and it now holds 8 million ounces against 48 million ounces of April futures claims, and 240 million ounces of total claims in that market. But that 40% drawdown rate is notable. And then the Shanghai Gold Exchange, in the AG T+D deferred delivery contract, it's down about 3.9 million ounces or 24%. So overall, we've now seen a draw rate of 57 million ounces in 5 weeks on all of the world's exchanges, which represents about a 27% decline. And I just want to note that if this draw rate of 57 million ounces a month continues at this rate or increases, the following month now, the following 5 weeks, we'd see about a 36% drawdown because the base that you're starting from is declining. So I don't see how this continues for another 4 to 6 weeks, Mario, before we have some kind of a market event. And the demand signal, the price signal that comes out of these exchanges will be extraordinarily intense. And I think there'll be a rush to secure what you can in these markets.
I agree. And if you look, the Chinese exchanges seem to be almost bare of any silver, and they're
Yeah.
the ones where we've got a bit of a premium as well. So I expect London and New York to follow. And like you've said in the past, David, the only cure for a shortage is higher prices. And I have a feeling I mean, as we speak here, we're trading just below 90 in spot silver. But I think if we break this 90 level, we could see fireworks. And I mean, and it's not even about making a profit in fiat currency. I think you need to hold on to your physical silver because of what's happening to the overall debt-based system.
Right. The fiat currency price of everything else is going to be going through the roof as well. But the Chinese premium this morning is about $12.50 or 14% compared to the New York and London cash prices. So, when we look at that 12.50 spread, it costs about $2 to ship these exchange qualified bars, whether they be kilo bars or 1,000-ounce bars for silver, to Shanghai. And so, for every million ounces that you move, you're going to be getting a $10 million notional profit selling it into the market there. So, that 12.50 translates to an incredible draw because of the extreme shortage on the Chinese exchanges into the Chinese market. And we've seen accelerating investment demand for certain in Europe and North America as well over the last year. And I think these combined now are going to put an end to this promissory note pricing system through extraordinary shortage, Mario. And, I don't care to make any kind of an estimate on where the price can go because it can be so extreme when these events happen. And given the fact that we're ending a period, 40-year period where the regulators, essentially the central bank regulators who were aware of this and utilized it, and the regulators of the exchanges themselves have acted to contain the price. This price fixing program, when it ends, is going to see something, I think, which is going to be difficult to believe in terms of where this stuff resets to in terms of fiat price.
Yeah, so to conclude, David, it's we've been I mean, I've been looking at this since beginning of the 2000s, and I've been called a conspiracy theorist and many others. Uh, and there are people out there in the silver market, also mainstream market, that say no, there's plenty of supply. But I think we're going to be proven right, and then conspiracy theories are going to become fact. And very few people
You're a
know.
fact checker then, right?
Yeah, yeah, very few people will understand what's happening. And I'm going to hold on to my silver dollar anyway.
You might need to get that back in your vault.
Yeah, that could be worth quite a bit. Well, it is worth quite a bit already. You look at small silver coins and you count, their weight, and then you translate it into the price per ounce, and you're like, I'm shocked. At 3, 4 years ago, it wasn't worth much, and now it's becoming
Right.
worth a lot more.
It's
So,
it's a signal of how egregious, Mario, the currency policy has been from these central
yeah.
bankers.
Yeah, and isn't it ironic that I think people like Larry Summers, he was Deputy Treasury Secretary under Robert Rubin, and he wrote
Mhm.
about Gibson's paradox, which is the signal that precious metals should,
Right.
and a lot of like people like Gada and Bill Murphy, uh, they speculated that he was hired to keep the gold and silver price lower through the leasing mechanism, and now it's turned out that he's not only he's been involved with all this stuff that's coming out, out of those files as well. It's amazing how all these people have been working together to keep.
I believe Rubin also came from Jay Aaron.
Yeah, that's where Jeff Christian comes from
Right.
as
So
well.
we have this, and yeah, and Ferdinand Lips wrote extensively
Yeah,
in his book, the War on Gold or Gold
yeah,
Wars. I can't remember, but he wrote extensively about the role that Jay Aaron played. And
mm,
then I mean, there's a number of analyses been made now how Jay Aaron was taken over by Goldman Sachs.
that's right.
And then a whole string of CEOs after that came out of the J. Aron gold trading division ended up running Goldman Sachs after that.
Yeah,
And certainly if they had known that interest rates were rigged by rigging gold and silver since the late 80s, that would have been a tremendous leg up for them in terms of trading these markets.
yeah, and Robert Rubin was made Secretary of the Treasury under Clinton, and then Larry Summers took over as Secretary.
Right.
And we've got Jeff Christian, head of the CPM group. He used to work for Rubin, and he keeps telling the world that there's plenty of silver. Uh,
Yeah.
so, so
Yeah.
he's still at it anyway.
Well, there is lots of it. It's just not on the exchanges at the current price.
Yeah, and it's really hard. A lot of it is tiny little specks of silver and millions of
Yeah.
items out there, and it's not economical to recycle it. Anyway, we dragged on a little bit, but anyway,
Yeah.
thanks again, David.
Thank you. My pleasure.
You're welcome.